So a debt fund earns interest income which is taxable, but pays off dividend which is exempt. How is this allowed?
Of course it's not allowed. The taxman understands that the investor can figure something like this. So what happens is that a debt fund which earns interest income pays a tax called the dividend distribution tax, or DDT. Now this tax is applicable when the fund's income is primarily made up of interest income. So all funds which earn interest income cannot earn a taxable interest income and pass on a tax-free dividend. They first pay the dividend distribution tax, which is a flat rate applicable across investor types, and only the balance amount is paid to the investor. So the distributable surplus of this fund is split two ways. One part goes to the government as tax, and the other part goes to the investor as dividend.
So all debt funds pay dividend distribution tax, isn't it?
It's not as straightforward. The taxman has a slightly nuanced answer to this. The objective here is to identify a fund whose primary source of income is not dividend. So only those funds will be subject to dividend distribution tax. The way the law defines this is by using that 65% number. If there is a fund and if at least 65% of its portfolio is invested in equity, then the taxman classifies this fund as receiving dividend income, and therefore this fund can pay dividends without paying any dividend distribution tax. Any fund, a debt fund, a monthly income plan, or any other fund where the portfolio does not have at least 65% equity, they will all be subject to dividend distribution tax, which means the taxman classifies these as products where most of the income is coming from interest and other sources, and therefore will ask these funds to pay a dividend distribution tax first and then pay a dividend to the investor.
So this means that the investor is not affected, is it?
Of course the investor is affected, because the net return to the investor is after the dividend distribution tax. So though the dividend itself is exempt for the investor, what happens is, of the total distributable surplus that the fund has accumulated, the entire amount doesn't come to the investor as dividend. So if a liquid fund has a dividend distribution tax of 30%, 30% is paid off to the government and the balance comes to the investor. So the investor's net return is going to be lower because of the dividend distribution tax. There is also another way in which the investor gets affected. The dividend distribution tax is not subject to any refunds under the Tax Act. So it's a flat rate that will apply across investors, which would mean that irrespective of their own tax status, investors get impacted by the dividend distribution tax in a non-equity oriented fund. And it's important to remember these rates, which can change from time to time. But as we speak, it's 30% for a liquid fund and it is 25% for all non-liquid, non-equity oriented funds.
So in a debt fund, if I choose the dividend option, my return is less, and if I choose the growth option, my return will be more.
That is what most investors think, and that's wrong, because the fund manager is managing only one portfolio. The fund manager is managing one portfolio, and the return on this portfolio is identical whether you chose a dividend option or whether you chose the growth option. Your return as an investor is going to be different under these options because the taxability is different. Therefore, if you chose a dividend option, let's say the fund has earned 10 rupees and you chose a dividend option. The fund pays out this 10 rupees. Of this 10, a part goes into dividend distribution tax and the remaining comes to you. So your return is going to be slightly lower. But if you chose the growth option, the entire 10 rupees which you can realize is going to come to you as capital gains. So your return can be different based on whether you chose the dividend option or the growth option. The fund's return is the same 10 rupees. Now this takes a little while to figure because to the investor what matters is the post-tax income. So if you are investing in a debt fund, you want to be careful about that because the dividend distribution tax is not subject to any refunds and it is a flat rate. On all liquid funds you are going to pay 30% and all non-liquid funds you are going to pay 25%. So this is a hit you get irrespective of your own tax bracket. So therefore you choose carefully. When you choose a debt fund, you look at what your tax bracket is, and according to that you make a choice between the dividend and the growth options.
This is so complicated. Which option then should I go for if a fund is paying dividend distribution tax?
It depends on what your own tax liability is. Let's take an example. Assume that you're an investor who is exempt. You're a retired investor. You're investing in a monthly income plan because you want to earn a regular income, but your own income is not taxable. Now, if you chose a dividend option, what's going to happen is the fund earns a certain return, but you're not going to enjoy the entire amount. Some money will get paid off as dividend distribution tax, and only the balance is going to come to you. But if you chose a growth option, since it's not subject to dividend distribution tax, because growth option is where you take the money out, you're not getting a dividend, then you're going to be able to redeem the amount and enjoy the entire return as capital gains. And since you are a retired investor, you're not going to be liable to tax on it because your income is lesser than the amount, the minimum threshold for taxation. So the choice you will make will depend on what is your tax status. The rule to remember here is simple. If your tax rate is say 30%, then if you chose a dividend option and therefore got a dividend distribution tax, and if that tax for the fund you have chosen is 25%, you're better off, because effectively you are paying only 25% as tax. So therefore, if your tax rate is high, you will choose a dividend option. If your tax rate is lower than the rate of dividend distribution tax, then you will choose a growth option. Assume you are a retired investor, then you should choose a growth option, because in this case you're going to receive the entire income when you book it as a capital gain. But if you chose a dividend option, you're going to lose that dividend distribution tax, and only the balance amount is going to get paid to you. So you have to know what is the rate of dividend distribution tax and what is your maximum tax rate. You compare the two and you make a decision on that basis.